This is Tesla's largest single quarter-over-quarter delivery decline in history. Let me repeat that. The worst quarterly performance ever for the company that's supposed to be leading the charge when it comes to EVs. The pioneer of EVs, some would say. What's going on, everyone? My name's Obi, and welcome back to the Courtside Financial Podcast, the podcast where we talk about business and technology. In today's news, we're diving into some fascinating developments in the EV industry that tell a much bigger story about competitive positioning, marketing strategies, and even survival tactics. Now, I know many of you tune in regularly because you're interested in NIO, but I'm going to keep it objective here. I'm going to talk about something important because let's be real, the market is way bigger than any one single stock, and the market is relevant to that one single stock. We're talking about a fundamental business strategy in one of the most competitive markets in the world. So whether you're team NIO, Li Auto, Tesla, or Xpeng, or just trying to understand where the market is headed, stick around because we're going to discuss just that. So let's start with Xpeng because this story illustrates something that I've been discussing for months. The Chinese EV market is absolutely ruthless, and only the smartest players are going to survive. Here's what happened. Xpeng just launched their G7 SUV on July 3rd, starting at 195,000 rent. Sounds great, right? Well, here's the problem. They already have a G6 SUV starting at 176,800 rent. So do the math. That's less than a 20,000 rent difference between their entry-level models. Now, any first-year business student will tell you that that's a pricing disaster just waiting to happen. You've essentially cannibalized your own lineup. So what does Xpeng do? They completely reposition the G6, planning to slash production costs by about 10,000 to 20,000 rand per vehicle. They're switching suppliers, redesigning supply chain, but keeping the same appearance and functionality. This is brilliant tactical thinking, but it also reveals something deeper about market dynamics. When you have to re-engineer your entire cost structure after launch because of internal competition, that tells me that pressure is real and it's everywhere. But here's what I find really interesting. They're planning a fourth SUV model codenamed the D03 at their Wuhan factory for 2026. This one's positioned like their Mona MO3, which starts at around 120,000 rent. For context, the Mona MO3 delivered 86,351 units in the first half of 2025, and that represents 44% of Xpeng's total deliveries. Think about that ratio. Nearly half of their business came from their cheapest models. That's not necessarily bad, but it tells you where the real volume is in this market, and it's not in the premium segment where everyone thought they could make easy money. The strategic lesson here, product lineup isn't just about features, it's about strategic pricing that actually makes sense to consumers. Xpeng had to learn this the hard way. Now let's talk about Tesla because their Q2 numbers just dropped and they tell a completely different story than what Elon Musk wants you to hear. The headlines are revenue down 12% year over year. Net profit dropped 20.7% to $1.17 billion. But here's the kicker. Free cash flow plummeted 90% to 146 million. That's not a typo, 90%. Vehicle deliveries were 384,100 units, down 13.5% from last year. This is Tesla's largest single quarter-over-quarter delivery decline in history. Let me repeat that. The worst quarterly performance ever for the company that's supposed to be leading the charge when it comes to EVs. The pioneer of EVs, some would say. But here's where it gets interesting from a business psychology perspective. Instead of addressing these fundamentals, Musk spent the entire earnings call painting visionary pictures of humanoid robots and robo-taxis. He claims Tesla will transform from a leader in electric vehicles to a leader in AI, robotics, and related services. Now, I'm not saying that these aren't potentially massive opportunities, but when your core business is declining and your response is to talk about completely different business opportunities, that's a red flag for any investors watching, in my opinion. The automotive gross margins tell the real story, 17.2% in Q2. Better than Q1's 15.8%, but still less than last year's 18% plus. Per vehicle revenue dropped to $42,231, down $500 from last year. They're cutting prices to maintain volume, but clearly it's affecting profitability. And here's something that most people miss. Regulatory credit revenue fell 50% to $439 million. That's pure profit that Tesla's NIO's losing as other manufacturers get better at meeting emission standards. So what does all this mean for the broader EV landscape, specifically for NIO investors like myself? First, the margin compression story is real across the board. Whether it's Xpeng redesigning cost structures or Tesla cutting prices, everyone's feeling the pressure. This validates NIO's battery as a service model even more. When other companies are scrambling to reduce vehicle costs, NIO's already separated the most expensive component of the vehicle, the battery, from the purchase decision. Second, the focus on affordable models is accelerating. Xpeng's Mona MO3 at 119,800 Ren represents 44% of their sales. Tesla's promised $25,000 model keeps getting delayed, but they've established a production date of June with a Q4 release. This is where NIO's strategy gets interesting. While everyone's racing to the bottom on price, NIO keeps building experiences. Battery swapping, autonomous driving capabilities, and lifestyle integration. It's a completely different value proposition from what we're seeing in the rest of the market. But let's be honest, the volume game matters, especially in China. NIO needs to prove that they can scale their premium approach while competitors are winning on price and volume. The Xpeng story shows that even well-funded companies with solid product lineups can still make some strategic missteps. The Tesla story shows that even market leaders aren't immune to competitive pressures and changing consumer preferences. For NIO, this creates both opportunity and urgency. Opportunity because the market is still defining itself, but urgency because the window for establishing a lasting competitive presence is closing. So look, I remain bullish about NIO and its long-term prospect, but these developments show us that execution matters a whole lot more than vision. Xpeng's repositioning shows how quickly you need to adapt. Tesla's results show that even dominant players can face some really big challenges. The EV market isn't just about the best technology anymore, it's about sustainable business models, competitive pricing strategy, and operational excellence. The companies that figure that triangle out, they'll thrive. But those that don't, they risk becoming cautionary tales. For investors, this means looking beyond quarterly deliveries to business models with resilience, strategic positioning, and margin reliability. The next 12 to 18 months are going to separate the winners from the ones that try. Anyways, that's a wrap for today's episode of the Courtside Financial Podcast. I hope you guys found this episode useful, insightful, at the very least entertaining. Help us out, hit the subscribe button if you found it to be any of those things. Click the like button, notification bell icon, and please leave a comment down below. Your engagement really does go a long way in helping out the channel. This is Obi signing off, and we will see you in the next episode of the Courtside Financial Podcast. Thanks for watching. This is Obi. Goodbye.